guys there? Hello, hello. Ready for some training?
And welcome to everyone. I see that you come from all over the world, and that's nice to see that we are a very international team. And I say a team because during all the days we will be together, we will work together, and we will help each other. Our aim will be to present you a very powerful trading method developed by late Dr. Jim Pruitt. Jim Pruitt, we have been fortunate last year to be taught by Jim, Tiger as we called him, and we have been approximately 300 traders to learn with the mentorship of Jim, and his aim was to give the traders a powerful trading method in order to change their life. And it is now the legacy of Jim that Chris and Craig have to support, and our objective is to also now to teach this method to as many traders as possible. I will begin my presentation with a little PowerPoint presentation, and I hope you will see it. Can you see my screen? Hello? Can you see my screen? Yes, okay.
We can see you, Eusebio.
Okay. So, an important key to success with the Max systems or the Max method will be for you work and commitment. You will have to work a lot. You will have to be committed to learn and to understand and to practice with the Max systems. And we will help you in this case with Chris, Craig, Jerry, and all the graders. We will help us to grade your homework, and you will have also to work with the homework of the other. You will learn a lot by studying how the other applies the Max systems, how they have made errors. We learn a lot from errors of other, and in that way your learning curve will be shortened dramatically. And our hope is that you will be operational as Max traders as soon as possible. We cannot say in advance how much time you will need to master enough to own enough the Max system. It depends of each person, and it will depend on the quantity and the quality of the work you will make with the Max method. Another key to success will be some important qualities you will have to develop: discipline. You will have to apply the rules at the time you will have to apply them. You will have to be patient. Patience to wait the correct setup with the Max method. You will have to be persistent, never give up if you have, for example, 1, 2, 3 losing trades in a row. You will have to wait the nice movement, which will give you as many pips you can get. You will need concentration to have success in analyzing all the signs, all the signals the market will give you. And of course, you will have to need courage to stay in the movement when the movement will present by themselves. So, and we are here to help you in this case. Well, how each session will be organized during this month of August? Each session will have several steps. We will present the concept in a progressive way. We'll illustrate this concept on several charts, several pairs, several time frames. We will practice the concept we will teach you by the examples, and then we will assign you homeworks as Chris has explained previously. And especially today, this evening, it is evening for many of you, it is the night for me, the content of this session will be the following. In the first step, we will introduce briefly what the Max is and is not. We will introduce then the important indicators we will use in the first step with the Max system, what we call the home base and the moving average. We will define what will be the main entry in a trend, and some scaling techniques and some exit techniques. When we enter a trade, we will have at a time to close the trade. We will see how the Max method applies to different pairs, to different time frames, and as Jerry as explained a few minutes ago, we can apply the max to any pairs, to any time frames, and even to any traded instrument in the world, like indices, futures, stocks, and so on. Well, now let's begin. What is the max? In fact, the max is the abbreviation for momentum, acceleration, exit. Momentum, we will enter in the trade when the price will begin to gain speed or momentum. We will exploit the trends. It will be the acceleration phase where, during where the profits we will accumulate will grow exponentially, and the X is for exit. At some time, we will have to exit to close all the open trade, or eventually also sometimes some partial trades to reduce the risk we have at any moment. And so we can tell that the max system is mainly a trend-following system. A trend-following system, we saw an initial entry, a scaling techniques, some profit to take partially until the final exit. And under farm-specific conditions, we will also exploit reversal or corrections, retracement, or trend reversal, but only under some very specific conditions. And I have to put your attention on two details, that the max is not a scalping method, and the max is not a news trading method. We do not trade the news. We do not scalp the market. So, now, many students, before attending the training, the webinar, ask the same question: what can we expect from the max method? And perhaps to give you a quick idea of what you will be able to do with this method, a recent and a frequent example is the best way to illustrate this one. And so this is a movement in the pound yen a few days ago. In fact, it was the 10th of July, 2 or 3 weeks ago. And at the moment, we entered a short trade here. We then take a partial profits. We made a scale-in, and here we made a final exit. We will see under what conditions we make all these kind of operations. Later, in the same day, during the same session, it was a session of 9 hours, we make a re-entry, a short re-entry, a series of scale-ins. At some moment, we took a partial profits and a second partial profits, and at a time, a final exit. And later on, we were still able to make a re-entry again, a short re-entry, with one additional scale-in, and again, a final exit. And these three max trades, we call each series of first entry and scale-ins until the final exit a max trade. So these three max trades allowed us to take a profit of 1,737 pips in a movement who was about 240 pips from this short entry to this final exit. And so, with this short example, you have an idea of the kind of profits you can make. Now, I must tell you, you will not be able to make this kind of result every day. You don't have a long trend every day. But with attention, with practice, with discipline, you will be able every day, day after day after day, to take more or less 500 pips a day. Some of you will make more pips, some of you will make less pips. It will depend on the courage you will have to stay in the trend. It will depend on how many pairs you will trade at the same time. It will depend on the time frame you will use for your trading. And so it will be up to you to find the time frame and the pair you will be more comfortable with. And for that, there is only one way to do that. It will be to practice. And the homework is the way to begin to practice, but between the webinars, between the homework which will be assigned to you, and after the training you will also to work and to continue to practice until you own the MAX method. Well, if you have some question, do not hesitate. If you do not understand perfectly what I'm explaining, do not hesitate to ask a question. I will try to do my best to answer as clearly as possible. So now we are going to begin to enter in the subject of the MAX systems. And I will display now the screen. Do you see my screen here? If somebody can say yes? Okay. Thanks. So here you see a naked screen, a naked chart without any indicators for the moment. And with two important words, though, patience and disciplines. This will be, as I said earlier, the minimum quality you will have to develop to be successful with the MAX method. So when we see a naked chart, what can we observe on this chart? We can see that the price is behaving in three ways. Sometimes we will have an uptrend, sometimes we will have a downtrend, sometimes we will have a consolidation zone. And you can scroll back in the past for any chart, any pairs, any time frame, you will always observe this kind of behavior. A consolidation zone, an uptrend, a consolidation zone, a downtrend. And so the MAX method will allow us to catch a good part of a trend, an uptrend or a downtrend. And here we have a question to ask to understand why the MAX method will work. It is designed first to catch the trends, but do we have enough trends in the market to make profits? You can take any pairs and you can scroll back on every period. This month, last month, 6 months ago, 1 year ago, 10 years ago, 20 years ago, you will always observe that when the market is trending, it makes nice trend. And typically, for example, for a volatile pair like the pound yen here, you will have an average daily range of 200, 300 pips a day. So we can also ask a second question. Who is making the trends? Why each pair have trends along a day or several days? So it's clear that the trends are made by the professional traders. The traders we call the big boys, which are trading in the banks, in the big institutions, in the hedge funds, in the big corporations, which count for approximately 95 or more % of all the transactions which are made on the Forex. We as retail trader, even a big individual trader or private trader, count for quite nothing and have no influence in the Forex market. Yes, the big banks, Rumi, as you say. But not only big banks, but also hedge funds, big corporations, and institutions, of course. To give you a little idea of the difference between a retail trader and a trader in a big bank, when we as retail trader, we trade 1 lot, 5 lots, 10 lots, even 100 lots per trade, these boys trade 10,000, 50,000 lots every day. So this is a very, very, very big activity. And of course, when the price is trending in Y direction, this doesn't mean that all the traders trade in the same direction. Of course, no. It is the resultant of all the positions which are taken in the market. But as the resultant movement represent big amounts, we can be sure that these movements will be persistent sometime. We never know how much time a trend, when it will start, how much time it will last, but we can say surely, and the experience can prove that the trend will last eventually several minutes, but also often several hours. when we trade, for example, the 5-minute time frame. But you will also observe this kind of behavior on any time frame you can choose, and we will illustrate that later during this session today. So, the system is designed so to catch trends. How do we define a trend? One of the better and simple way to define a trend is to use a moving average. So let's put a moving average on this chart. And I will take an example here. I will take a moving average absolutely arbitrarily. For example, here I have put 150 period moving average. And let's see how the price behaves compared to this moving average. When you see the chart from the beginning of the historical quotes here, you see that sometimes the price will be under the moving average. It will be in a downtrend. Sometimes the price will cross up from below to above the moving average. Sometimes the price will make a pullback on the moving average or very near the moving average. You see here a pullback before the trends resume. And then here the price crosses down the moving average. It makes some pullbacks. And then it crosses up the moving average. It makes a pullback. It goes upward. And then it reverses back and crosses down the moving average. And so on, and so on, and so on. And you can take every average you want. You will have always the same behavior. Example. Let's take a second moving average. This is the second moving average. I've also taken a number of parameters, which is everything, 33. These are not relevant value for the moving average, but let's see what happens with this moving average. We also see the same behavior. Sometimes the price is above the moving average, sometimes it is below. The price crosses, example here, down the moving average. It makes pullbacks on the moving average, and the trend resumes. And then the price reverses back. It goes above the moving average. It makes a pullbacks. The uptrend resumes, and then the trend reverses back and crosses down the moving average, and so on and so on. Of course, the place where the price crosses up or down the moving average for a short moving average is not the same place as for a longer moving average. The place where the price pulls back on the moving average or near the moving average is not the same place as for a longer moving average. But you see that the behavior is the same. This means that this is an important consequence. If we speak only on a technical analysis basis, there is no magical moving average. There is not a best value for the number of bars or the periods for the moving average. But that is on the technical analysis point of view. Now, we can tell you that there is one special moving average, which is the best moving average. And this is this one. And we will call this moving average here the home baseline. And the home baseline, I will explain you why it is important. It is a moving average of 233 period. It is an exponential moving average on the medium price, high plus low divided by 2, with a shift of 3 bars. The shift is not really relevant. I will explain later why the shift is used. It is the home base because, as explained previously with the other moving average, you will see the same behavior. The price will go from one side to the other side of the moving average. It will make some pullbacks. Sometimes it will rest sometime on the moving average. You see here, the price stays sometimes around the moving average before the trend resumes. And so the price bounces off the moving average and then comes back to the moving average. This is why it is called the home base, and why the 233 moving average is important, because it is the moving average used by many professional traders. many traders in banks, and I have seen that in the past. I have had the privilege to meet many professional traders in banks. In my previous professional activities, I have worked a lot in dealing rooms as information technology and computer engineer. And the 200 moving average is very important. The traders are trained by their banks or by a training center that if they take a trade in the direction of the trend, for example, when the price crosses down here, the moving average, the 200 moving average, they take a short trade. At the end of the year, they will make a profits on these trades. So this is why the 200 moving average is very important. This is the separation line between long trades and short trades. But there is still
Eusebio?
one other point which is very important.
Hello, Eusebio.
Yes, Jerry. Yes, Jerry. Chris, sorry.
Sorry, just two things. One is, could you zoom the chart out so that you can actually see smaller candles, and you'll be able to see it bouncing off the moving average a bit more. And there's a bit of discussion about the old 89 being the home base versus the 233 moving average being the home base.
Yes, okay.
Some people are missed out those sessions from Jim. Thank you.
Okay, no problem. Do you see better the chart now if it is zoomed in this way?
Sorry, I meant it to go the other way so that you could see more of the movement over several days, how it comes down and touches. Yes.
Zoom out, so.
Yeah.
This way.
Exactly.
Perhaps. Okay.
Thank you.
So, it is true that in the past, in the first webinar, Jim used the 89 moving average as the home base. And it was great. It was nice. The max system was working fine. And I will explain in a moment why the 89 moving average could be considered the home base. But he then introduced later the 200 moving average, and this works better. And the reason is because the professionals use the 200 moving average as the home base. But there is another point which is used by these traders with the 200 moving average. So I have said that if they take the trade in the direction of the price compared to the moving average, they will make a profit at the end of the year. But if they wait before entering for a pullback, you see here, it's a perfect example, the price crosses down the moving average, then the price progresses downwards, and then it makes a pullback just on the right on the moving average, the 200 moving average. And then the price resume its downtrends. If we enter a short trade here on this pullback, then the result at the end of the year will be dramatically increased. The profits will be much more important, and the winning rate will be much more important. This is why in the rest of the method we will attach a great importance to these pullbacks. And by using the 200 moving average, here more specifically 233, and we'll tell in a moment why we use 233, and this pullback, we have a way to follow the footprints of the big boys. And this is why the max method is working efficiently. Now, to this home base, we will add 3 other moving averages. I will take the next template. Here are the 3 other moving average. We have the yellow moving average, which is called the MO line, the momentum line. It is a 21 period moving average with a shift of 3 bars. It is an exponential moving average on the close price. We have the blue moving average, which is called the balance line. The blue balance line, it is a 55 period with a shift of 5 and an exponential moving average of the close price. And the third moving average is the red line, which is our old home base, and it is the 89 period with a shift of 8 and always an exponential moving average. And so why are these three moving averages important? They are important because they are also moving averages using by the big boys. They are more specifically using the 100 moving average instead of 89. But 89 and 100 are not very different. They are also using the 50 moving average. We use the 55 moving average. And they use the 20 moving average. We use the 21 moving average. And 21, 55, 89, 233 are Fibonacci numbers. And Fibonacci numbers are very, very important everywhere in the nature and also in trading methods. And the Fibonacci number here in the moving average give us a visual trick to better estimate with some harmony in the behavior of the moving average what the price is doing. And we will explain that in detail as long as the sessions will develop in the following weeks. We use also a shift on the three moving average. It is not an obligation, it is a visual trick to better see what we will call angle and separation, and I will illustrate later. Now, with these moving averages, what are we going to do to define our entry point? And so to better illustrate that, let's begin in the past, at the start of a trend. Okay, do you see well my chart here? Because this will be very important. Okay, thanks. So here, you see that the price is bouncing off the home base, line. And you see also that at this point, and I will draw a vertical line, at this point, here, the momentum line crosses up the red balance line and also the blue balance line. And do not forget that these lines are shifted, 3 bars for the momentum line, 5 bars for the blue line, 8 bars for the red line. And so, here, when the momentum line crosses up the blue and red line, it is not on this bar, but it is 3 bars earlier. So it is 1, 2, 3. It is at the end of this bar. Okay? I will draw another vertical line on the bar, which we call the setup bar. So it is the bar when the momentum line crosses up the blue balance line and the red balance line. And it is also important that for a long trade, we have these three, or at least the momentum line above the home base line. We will illustrate that in another example later. To enter here the trade, we see that at the end of this bar, the price is rather far from the home base. So we do not enter immediately at this level here, but we will wait as the big boys a first pullback. A first pullback right on the momentum line. This is the ideal situations, or sufficiently near the momentum line. And here we have a very nice pullback, which will give us our entry. And we can draw the resistance lines of this pullback. And when the price on one candle here, on one bar, will crosses up this resistance line, we will have our entry. We will call this entry a momentum entry, a MO. Momentum entry. And then, later on, after this first entry, depending on the price action, we will make a series of scale-ins. For example, here we will make a first scale-in eventually. There we will make another scale-in. There we will take probably a profit. Then here we will make another entry. There another entry. Here another scale-in probably. There another one. Here another one. And there probably an exit or a partial profit taking. And we can continue as long as the trend is a nice trend and as long as the three moving average are well pointing upward and well separated. And we will explain that later on more in details.
Hello, Eusebio.
Yes, Chris.
Sorry to interrupt your profit taking there.
No problem.
Okay, there's a couple of questions have come up. One is, where do the big boys exit if the big boys are using the 200 to enter? And the other question is, why are the moving averages shifted forwards in time?
Okay. So as I explained, the shifts are used only as a visual trick to better see. Let's go to the end of the chart, angle and separation. I will illustrate later in more examples when I will be more precise, more accurate on the first entry. And for the exit, we never know in advance where the big boys exit their trades. But we will learn a lot of techniques to exit the trade. We will have perhaps 12 or 15 or quite 20 exit techniques. And we will have to learn some signals, some signs the market will give us, which will tell us, here now the movement is becoming weaker, and we will be prudent to exit. And sometimes we will have a clear sign that the trend is over. But we will see each point at a time, okay? So, but let's first of all concentrate on the first entry in the trade. Here I have waited for a first pullback after the yellow line has crossed up the blue balance line and the red balance line, but we have to give a more accurate definition of what is a momentum entry. So let's take off these vertical lines to better see what happened. So the definition of a momentum entry is, for a long trade, we have to see the price above the momentum line, the home base line. We have to see, preferably, there is some exception we will see later, but we have to see preferably the momentum line above also the home base line, and we have to see angle and separation of the three moving average and also of the four moving average. The momentum line, the two balance line, and the home base. Here, for example, you see you have angle and separation. The angle because the three moving average are pointing up in the direction of the trend, and also the home base. And separation, you see they are well separated. Let's go back a little in the past, some bar in the past. Here, you see that the price is in a consolidation zone, and what are the three moving average doing? They are intermixed. They are mixed together. We call that zone a spaghetti zone. You don't have angle and you don't have separation of the moving average. So this is not a tradable situation. When the moving average begins to separate and to have angles, then this means a trend is beginning to start and the price is gaining momentum, and this is the right moment to open a long trade. Now, on the past charts, it is sometimes difficult for some people to see what the moving average are doing with the shift we apply to the moving average. And we have always to take that into account. Let's illustrate that, and for that I will do a zoom in on the chart. Let's go back here, okay? And let's draw a vertical line here. Well, here, on this bar. At the end of this bar, since the more line is shifted 3 bars to the right, where is the last point of the moving average of the momentum line at the end of this bar? So it is not here. It is 3 bars to the right. We count the bar, 1, 2, 3. So the mo line, in fact, is here, because it is shifted 3 bars to the right. The blue line is shifted 5 bars to the right. So at the end of this bar, where is the last point of the blue balance line? It is 5 bars to the right. 1, 2, 3, 4, 5. So it is here. And for the red balance line, it is 8 bar. 1, 2, 3, 4, 5, 6, 7, 8. So it is here. If this was a real-time situation, this would be the last bar you would see, and you would see that the yellow line would be here, the blue line would be here, and the red line would be here. And so you see that they begin to have angle and to have separation. So this bar is a setup bar. The setup bar is the bar when you begin to have angle and separation of the 3 moving average. If the yellow moving average also is on the right side of the home baseline. And there is also another additional conditions to see if the entry price will be a right one. And for that, we will add to the moving average what we call training wheels, this way. It's a channel at plus and minus 10 pips around the moving average. And we will color that also in gold. Okay, this is a concept which has been introduced by Catiline, of a very well-known trader. And so we want to see also the price at least outside the training wheels. This means that the price has to have progressed at least 10 pips from the momentum line, but not too much. Here we see that we have a long bar compared to the previous bar. We can surely say that we are too far the momentum line. And so this is why we have to wait for the pullback. And as you observe here, the pullback with this bar, the pullback comes quite right on the upper training wheels. So this shows that this point is a good pullback. And so on the next one, on the next bar, you can enter. So, and you are still sufficiently near the training wheels. If the pullback would be more deepened and the price come just near or right on the momentum line, it would be also better. But then you will have to wait that the price at least goes outside the training wheels, which indicate that the price has enough momentum to initiate the trends. Okay? So that is very important to understand as the first concept to open your first trade. This is a very important condition to have a very, very high success rate for your first trade. And the first trade, as it is the beginning of the trend, is always a risky trade. And so you have to take all these conditions into consideration. Let's see some other example. For example, here. Here we have a situation which is not tradable. Why? We see that the moving average here, first of all, are not in the right order. We don't have, even if the price is above the momentum line, we don't have the yellow line above the blue and above the red line. And so we have to wait. And we wait until when? Until when the momentum line crosses up the home base, and even the channel around the home base. It is still better. And what is this channel? I have forgotten to tell you. So if the home base line is the 233 period exponential moving average, the upper band is the same exponential moving average but of the high, and the lower band is the exponential average of the low. Okay? And so when the momentum line crosses up the home base and even the channel here, and crosses up the blue line and the red line, and the blue line crosses up also the red line here, then you know that the three moving averages are gaining angle and separation. They begin to be separated, even if the blue and the red here are not well separated. They begin to separate, and they are pointing up. And so where is the price at that moment? So we know that here, at the moment when the blue price, the blue line crosses the red line, we are 5 bars. We have a shift of 5 bars, so we are 1, 2, 3, 4, 5. It is on this bar that we have the blue line crossing up the red line. And here we are far from the momentum line and from the trailing wheels, so we are too far to open a first trade. So what do? We wait for a pullback. And where is the pullback? It is very easy to see. Then we have 1, 2, 3 red bars, and then a blue bar here, which comes right on the momentum line. It is easy so to draw the resistance line of this pullback here. And so you have your entry point here on the next bar, on this bar. So this is your momentum entry, your MO. Okay? Is this clear? Does everyone understand this concept? It is very important for the rest of the training. Later on, in the next session, we will see still more accurately what a momentum entry is. There are some subtleties, some difference to distinguish for the first MO, but for the moment this is enough as a definition for today. Then,
Eusebio.
Yes,
sorry.
Chris?
Some people asked to explain the offset again, so I think it would pay to go back over it. Thank you.
Yes, I'm sorry, I don't see all the questions because my Chatsi, I have always to refresh.
No, I understand. That's all right.
Why I am concentrated to explain the concept. It's not easy to see all the questions.
Sure.
So, but you make well to remind me so. So, the MO line is shifted 3 bars. The blue line is shifted 5 bars, and the red line is shifted 8 bars. The aim of this shift is when you are at the far right end of the chart, it helps you to see if the 3 moving average begin to have angle and separation. I have said it is not necessary to have this shift, but if you don't apply the shift, you will not see immediately when they begin to separate and to have angle. So the shift is just a visual trick to see when they begin to separate. You will easily see when they have angle. Here, when they are pointing up or down in the same direction, they have angle. But it's not always easy to see if they begin to separate. And so by applying them a shift, a different shift, you see more easily if they separate. And that you will have to check on your chart, on many charts, on the last bar of the chart. But when you need to study a past chart to see where is your setup bar, you have to take into account this shift to make a correct interpretation of what the price is doing. For example, let's take a downtrend, a short trade here. Here you have the momentum line which crosses down the home base here. Okay? Is it on this candle, on this bar, that the MO line crosses the home base? No. The MO line is shifted 3 bars to the right. So it is on 1, 2, 3. It is on this bar. It is at the close of this bar that the momentum line crosses the home base line. Do you understand why? On the close of this bar, the momentum line is shifted 3 bars to the right. So it's the extreme point. If this would be the last bar of the chart we are saying, the last point of the moving average will be here. 1, 2, 3 would be here. Okay? 3 bars to the right. 5 bar for the blue line. So here. And 8 bar for the red line. This would be what you would say, what you would see. Let's put the chart this way. Imagine that you don't see these bars. You see only this last one. You would see that the mo line would end here, the blue balance line would end here, and the red balance line would end here. And with some practice, it will be easier to make this difference. Well, so here, when you have the momentum line crossing down the home base line, you see that the price is far from the home base and from the training wheels. So we will have to wait for a pullback before to open the trade. And we have here a first pullback. You have two blue candle, this small retracement, and with this red candle for which the price is not too far from the training wheels, we could consider to enter here. So we draw here this time the support line of this pullback, and so we can enter on the next bar. If we want to wait for a safer entry, what we call a safe and perfect mo, we can wait for a pullback right on the mo line or the momentum line or the training wheels, which happens a few bars later exactly here. We could then draw the support line of this pullback here, that way, and you have your entry. Here you have the setup bar, and so here you have the entry bar. And so now, to enter the trade, you have several methods. You can enter, a first way to do is enter directly at the open of the entry bar, here. If you want a more safer entry, you can wait for the price going outside the close of the previous bar, of the setup bar, a few pips below. So here is the close of the setup bar. You can enter a few pips below. And a more safe entry technique is to wait the price to go below the low of the setup bar, here, a few pips below, for example, here. And the choice is yours. It depends how you feel comfortable to be more aggressive, or if you feel more comfortable to be more conservative. Personally, I prefer to enter as soon as the price begins its down movement, as when I see the price committing itself in the direction of the trend, here we are in a downtrend, so as soon as I see the bar is becoming red, I enter. I wait for a few pips, for example. I wait for the price crossing the support line of the pullback, and I enter immediately in the price. But the choice is yours. Well, sometimes during the trend, we will see later that we will exit our trade, and we will have opportunities to re-enter in the trade when the trend resumes. And we will always apply the same concept of the MO, momentum entry. For example, here, probably here in this downtrend, we will have an exit somewhere here, for example, and I will explain later why. And you see then the price is making a pullback, is retracing, and it retraces until and even above the momentum line, and then it crosses down again the momentum line, here, for example. So this is also a setup bar for a momentum entry. This momentum entry respects the conditions of the momentum entry. The momentum line is below the home base line, it is below the blue line, which is itself below the red balance line, and the price is below, or closes below, the momentum line. So this is your setup bar. If you are not sure if the price has closed below the momentum line, you wait for the next one. So this could be also your setup bar, and you enter on the, for example, there, on the next bar, this one or this one, with the different techniques I explained a few minutes ago. If you don't take this entry, you have another one which presents itself just a few bars later. Here you have again a pullback above the momentum line, and then here you have again a setup bar. The price crosses down the momentum line and closes below the momentum line. And so you have an entry point on the next bar or the following, depending the way you enter the trade. This is also called a MO. But to distinguish between, to make the distinction between the first MO here and the MO here, this MO we will call the re-MO. Re-entry. Momentum re-entry, or re-MO as an abbreviation. We will see other distinction for the MO in the next session. So, this definition, this concept of the MO and the re-MO is very important for you to understand, and it will be the subject of the first homework which will be assigned to you. It will be to recognize in the past several MO and re-MO. Let's take another example. Here, for example, it's not the first time that the price crosses up the home base line. The trend has begun sooner, but we see here that the price has gone under the moving average. It has made a retracement, a pullback, and then it crosses up again the moving averages. And we have the MO line above the blue balance line and the blue balance line above the red balance line. And so we have the three moving average in the right order, and they are all pointing up in the direction of the trend. And where is our setup bar? It is here. This is our setup bar. If we count indeed 3 bars to the right, 1, 2, 3, we see that the MO line is here. The blue line is 5 bars to the right, and the red line is 8 bars to the right. So we have the good setup bar here. Does the price reach the training wheels? Yes, it reached. So we have ideally it should close near the training wheels or above the training wheels. So if we do not consider that this bar is not a setup bar, we wait simply for the next one. And so this is our setup bar, and so we have our entry on the next bar. Okay? And then somewhere here we'll make an exit, and later we will have, here we see a pullback right on the training wheels or here right on the momentum line, so we can have another entry here, for example, there or there, here. And then later we have another re-MO here, another here, and so on. Well, do you have question on this first definition of the first entry in the trend, in the direction of the trend? No? No question? Okay.
You say
so, yes, Chris.
Hi. We're at an hour 10 into the session so far. And we've got about another hour left. So
yes,
maybe
I would propose to make a little interruption here.
Sure.
Nice. Well, one of the students has asked a very interesting question. Do we have to wait for the 3 moving average being on the same side of the home baseline? For for example, above the home baseline for an uptrend or below the home baseline for a downtrend. For the moment, yes, you would consider that the 3 moving average must be above or below the home baseline. Later, in the next session, we will see exceptions to these rules. But let's go not too far. As I have said earlier, the concept of the max method are simple, but they are not always easy to apply. So one point at a time, we will go progressively. Okay? So now, you have seen here that in this example, we have made several scale-ins before an exit. How do we make scale-ins? So in general, when you understand more and more the price action, you will see that a scaling is done essentially whenever the price make a pullback, like here, or make a ledge. What is a ledge? A ledge is a kind of consolidation with an horizontal resistance line or an horizontal support line. We can also scale in this case of situation. And there are also other conditions where we can scale in. But mainly, we scale in at pullbacks. And to better visualize where the pullbacks happens and where you can scale in, so we will use another indicator, which is the MACD in color indicator, and I have that on my next template. Here it is. This is this indicator. In fact, it is a MACD with the following parameters: 3, 6, 3, and in which we have given known colors to the moving average of the MACD themselves. For example, here are the 2 moving average of the MACD, and you have in blue and red the histogram of the MACD. Only the histogram interests us, so we don't draw the 2 moving average of the MACD, and so we can suppress them, so we simply hide them by giving them the known color, this way. Okay? And the way to scale in is the following. Let's go back to the previous example, where it was here, I think. So here we had our first momentum entry. I will write it with larger letters. And so, the rules is very simple. For an uptrend, whenever the MACD turns from red to blue, we have a potential scaling. Here, you see, the MACD, the histogram of the MACD turns from red to blue. You have another one here. 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 Whenever the MACD turns from red to blue, you have a potential entry for a scaling. Now, you are not obliged to take all the scaling, and I will explain that more in detail in a moment. But here, how do we enter the scaling? There are several ways to enter a scaling. The first way, and the safest way to enter a scaling, is to wait for the bar to close, so that we have a confirmation that the MACD has turned from red to blue. And so, here, we wait for this bar to close, and we enter on one of the next bar. We have several techniques for that. As I explain later, we can enter directly on the open of the next bar, or we can enter when the price goes above the close price of the setup bar, or when the price goes higher than the high of the bar. But there will be an exception, and it is an exception which will be true in every case of entry. We never enter on a long bar. You see this bar? is a long bar. What is a long bar? A long bar is a bar which is a length which is at least twice the length of the previous bar. You see these bars, the length they have. So clearly, and you see that visually with a little practice, this is a long bar. It is quite twice or even more than the average length of these bars. We never enter after a long bar. To enter the scale-in, we have to wait for a pullback. And the pullback, because on a long bar, you have quite always a retracement. The retracement happens here some bars later. It is coincident with the next scale-in, and so this scale-in is a good one. And so you can enter on this scale-in. Okay? And we note a scale-in with the abbreviation SC. SC for scale-in, and we give a number to them. And this is the way we'll have to note your chart in the homeworks. So, the next scale-in is here. If you wait for the bar to close, you see that this bar is also a long bar, so you do not enter on after that bar. You wait for a pullback, and the pullback is a deep pullback. You have seen the price comes back right on the Mo line. And on the next time the MACD turns from red to blue, you have now the right setup to enter. And depending the techniques you use to enter, for example, if you wait for the price to go higher than the high of the setup bar, you have no entry. If you decide to enter when the price opens, you will enter here. And if you wait for the price to go above the close of the setup bar, you will perhaps enter, depending on how many pips you take to enter. Another exception to not take a scale-in is, let's suppose that you make a scale-in here. And we know that scale-in number 2, okay? There will be an exception to not take a scale-in. If the entry price of the scale-in is too near the entry price of the previous scale-in, don't take the scale-in. Because this means that you take a double risk. You double your risk on the scale-in. You have to wait sufficiently space between each scale-in. For example, on the 5-minute time frames, it's nice to have 20-25 pips from each scale-in. For a volatile pair like the pound yen, for normal volatile pair like the euro USD, like the USD Swissy, like the USD CAD, even 15 pips are sufficient. But if you have less pips, don't take the scale-in. Wait for the next one. Okay? Trading with success is also and is mainly managing your risk. You will have to focus not on your profit. You have not to run for your profit. You have to manage your risk. And this is something we will see in detail in one of the last session of this webinar. So, and this is a very, very important question. So here you have, in this max trade, you have 2 scale-in. The way to note on the chart the scale-in, so whenever you have the MACD turning from the red to the blue here for the uptrend, you trace a vertical line, and on the price level where you enter, you draw a slanted line, like here, this way, for example. Okay? And you make a little note for the number of the scale-in. Scale-in 1, scale-in 2, scale-in 3, scale-in 4, and so on. When you will catch a big trend, you may have 8, 10, 12, 14 scale-in. And you will encounter this kind of situation, and then it will be the case where you will make a huge amount of pips. Okay? This is important to note the chart this way, because in your homework we have to see clearly the intention you put on your trade, how you have managed your trade. We cannot read in your mind, we cannot guess what you are doing. If you note properly your chart, we can see exactly what you have done. Okay? And it will be important to respect this kind of notations. Let's take another example. Let's take a short trades. Let's find one. Here, where the trend begins. It begins here.
Hi, Eusebio.
Yes, Chris.
Hi. Sorry to keep interrupting. Could you, in honour of Jim, count some pips as well? When you,
yes.
Yeah, just so that people get an idea on how the
yes,
SCs mean scaling.
I will show how we count the pips in this example. So.
Okay, thank you.
And I will ask a graduate student, a volunteer, to count with me. Vanessa, for example, are you ready to count? Hi, Vanessa. Okay, let's go on. So, here, where is our entry? We have here the momentum line crossing down the home base line. And so we know that the Mo line crosses the home base line 3 bars earlier. 1, 2, 3 on this bar. We are too far from the home base and we are too far from the training wheels and the Mo line, so we wait for a pullback. And we have a good entry here or better here. This is our perfect safe and perfect Mo here. We note Mo. We have then a series of scalings. And this time, as we are in a downtrend, we are looking for the MACD turning from blue to red. From blue to red. So here, the first one. Here, a second one. Here, a third one. Next one. Here. 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 And let's take another one. Here. Okay. For this scaling, we are perhaps too near our first entry. Yes, we are at only 9 pips, so it's too near. We ignore this scaling. For this one, we are at 13 pips. It is still too near. We ignore this one. At this scaling, we are at 17 pips, or at this one, we can consider to take this scaling. Next one is here. We are far enough from this scaling, so we can take the scaling which is here. And we don't forget to note them. SC1, SC2, here, this is a special case where the entry is above the previous scaling. But what we observe is that the price has made a pullback above the momentum line and crossed down again the momentum line upward. So we have a condition which is filled for a Mo. And so in this case, we consider it is a possible scaling. So we can take this one. How many pips do we have from the previous one? We have 14 pips. It's a little just, but as it is a condition for the Mo line, personally, I consider to take it. And so we note it as C3. Again, we have the same situation here. We can enter, for example, here, but here I will skip this scaling because we have a long bar, and on a long bar, I never enter. I forget this one. I skip this one because we are too near this one. We have an excellent here scaling, here, there, for example, and so we note it as C4. Well, and we have another scaling here, but we will ignore it because I will make my exit here. I will explain you in a few minutes why I make an exit here, and we will take also a partial profit here, and the partial profit we will note them MX momentum exit number 1, and here it is the final exit, and the final exit we will note it x66. Now, to calculate how many pips we have extracted from this movement, I have to explain you how we open, how many trades, how many lots we open on each trade, on each situation. We will not speak about lots, we will speak about unit. On each entry, a momentum entry and a scaling, on every scaling, we always enter 2 units. 2 units. And the size of the units is whatever you want. It depends of your account. It depends of the risk you take on each trade. A unit may be a micro lot, it may be a milli lot, it may be a lot, it may be 10 lots, it may be 100 lots. It depends of your account and the risk you are taking. And so 2 units, if you trade 1 milli lots for 1 unit, 2 units will be 2 milli lots. Okay? 2 units. And whenever we will make an exit, an MX, a partial exit, we will close only 1 unit. And we keep 1 unit in the open. Why we keep 1 unit open? We keep 1 unit open to exploit the rest of the movement. But we have closed here 1 unit to reduce our risk, to bank some profit. And when we will see more in detail the money management later, we will see that taking as soon as possible a first profit will be very, very important. And so here, when we close all the open units, we have how many open units? We have 2, 4, 6, 8, 10 minus 1, so 9 units here. We close 9 units here. Okay? Now we will count the pips we have made on this movement. So we start. We have a first unit here. We have closed here, making 72 pips. Do you make the calculation, Vanessa? So 72 pips. Let's take off the spread, which is 7 pips here. So let's say 65 pips. And on the second unit, we make 200 pips. Then, on the first scaling, we make 182 pips twice. On the second scaling, we make 140 pips twice. 140 pips twice. On the third scaling, we make 150 pips twice. On the next scaling and the last scaling, we make 115 pips twice. What is the total? $1,439 pips. For a movement having a range of 200 pips and a trade which lasts 60 bars, which means 300 minutes. This means 5 hours. Okay? Now, why do we count twice the pips on each trade when we have 2 units? Because have you seen here, we are in a situation where sometimes we have to close 1 unit. So this means that whenever we open 2 units, each unit will have its own life. We are always susceptible to close 1 unit independently of the second units. So it is the reason why we count the pips for each unit. Of course, we can always criticize this way of counting. If we have a losing trades, of course, we have also to count twice the pips on the losing trades. That's normal. But the advantage to count the pips this way is that if we take, for example, 1 lot for 1 unit, we know that 1 pips is around $10. It depends on the pair. For example, for the pound yen, the pips value for one lot will be approximately $9.50. So if we have made 1,439 pips on this movement, we just multiply by the pips value of 1 unit, not 2 units, the half of the trade, so $10 here, we would have made a profit of $14,390. This is clear? Do you understand how we make the counting and why we make the counting this way? So we count the pips for each unit because each unit has its own life. Each unit may be considered as a separate trade. We can always close one of them independently of the other. For example, here we could have also closed one unit here if we had choose to do that. We will see that later with some exit techniques. Okay, this is why we have to count the pips on each unit separately. Okay? Well, you will have to note the chart this way. So a vertical line for each scaling, the numbering of the scaling, a slanted line for the price level entry, and a slanted line for your mode, and an horizontal white line for your final exit. Okay? And you will count the pips the way I have done just in this example, and you will note the total value of the pips you have made on this max trade. Well, now, let's talk about the exit techniques. Here, I have shown that we made a partial exit here. We could have made also one partial exit here and a final exit here. We will use a main indicator, specific indicator, to help us pinpoint the place where to exit partially or totally our position. And for that we will use the store RSI indicator here with the parameter 883. Oops, sorry, I will not put it on this window. I will put the store RSI together with the MACD here. Okay. Well, you all know stochastic indicators. We don't use the stochastic itself. We use the store RSI. It is the stochastic of the RSI because the stochastic itself is too reactive. The RSI is not reactive enough, but the stochastic of the RSI will do exactly what we need to do. I will explain also that more in details in one of the last sessions, why we choose the parameters of these indicators. So, the main place to exit, or to consider to exit one unit, is whenever the stochastic is here in the oversold zone for a downtrend, or in the overbought zone in an uptrend. Not only in the oversold or overbought zone, but when the store RSI make a bottom in a downtrend or a top for an uptrend. You see here, exactly here, the store RSI has made a bottom in the oversold zone, which is defined by the zone between 0 and 20%, and the overbought zone is between 80 and 100%. And when the store RSI crosses up the 20% line here. And if we draw a vertical line where the store RSI just crosses up the 20% line here, you see we are in the zone where I have noted to take a profit. Okay? Let's see here, for example, this situation. You have the bottom here. You have the store RSI crossing the 20% line here, just in the zone where I have marked the take profit here. And here, we have a bottom in the oversold zone, and where the RSI crosses up the 20% line here, we are in the zone I have indicated to make an exit. This is the same thing in an uptrend with the tops of the RSI. But there are more with the RSI, of course. You know, for example, that with oscillators, an important sign given by the indicators is the divergences. Here we have an example of a divergence. I hope it is an example. Let's check. Oh, it's quite a divergence. Yes, we have these two bottoms which are horizontal, and here the corresponding bottoms in the price are downward. Okay? We have here a divergence in the price. Okay? A divergence, we have a bullish divergence. A bullish divergence will always be considered by comparing the bottoms of the price with the bottoms of the oscillator. It is not necessary to have a strict correspondence of the bar at the bottom of the price with the bottom of the RSI. We may have a difference of 1 or 2 bars because the indicators will be sometimes lagging, sometimes it will be coincident, sometimes even it may be leading. So the bottoms may be distant for 1 or 2 bars to the left or to the right. What is important is to see the bottom here and the corresponding bottom here in the price. And you see here we have 2 lower lows in the price and we have 2 flat lows in the RSI. There are 2 kinds of bullish divergence. When you have 2 lower lows in the price and 2 higher lows in the RSI, or 2 lower lows in the price and 2 flat lows in the RSI, and you have also a third case. You have 2 flat bottoms or low in the price and 2 higher lows in the RSI. And you have also the reverse, the contrary, in an uptrend, but this time you consider not the lows of the price and the RSI, but the tops of the price and the RSI. Okay? Normally, if you if you are used with technical analysis, you should be comfortable with the divergences. Now, if you are not comfortable with the divergences, don't hesitate to ask questions here or in the Max Google group when you will post your homework. So here I have said we have a divergence, and a divergence is always indicative that the price may retrace. It is not indicative that the trend may reverse, but at least that the price may consolidate or make a retracement. Sometimes this retracement may be a trend reversal, but we cannot know in advance. We cannot, we have no indication, never, that a divergence will indicate a trend reversal, because the indicators and the oscillator in particular only pinpoints the short-term, the very short-term tops and bottoms in the price. When the divergences appear far from the beginning of the trend, this is always a clear sign to close all your open units. If you had divergences at the beginning of the trend, it's not necessarily an indication to close all your open units, but only to close, for example, 1 unit to reduce the risk you have on your remaining position. Okay? Another way to reduce your risk is to tighten your stop loss. At each trade we will open, we will place a stop loss, but we will see the stop loss in a session later, because we will have to see other points, we will have to add other indicators to our charts to better point where to place our stop loss and how to follow our trades with an evolving stop loss. So,
hello, Eusebio.
Well, yes, Chris.
Hi. Some questions have come up. One is from Sean.
Okay.
who asks, he or she has a question regarding MXs, partial exits.
Yes.
If you were to have a second MX, MX2,
Yes.
do you close half of all the open units or only the second unit of the scale-in?
Okay, that's a good question. Here, for you, I have indicated we could have made a second MX. Let's note it, MX2, it is the second MX. We close one unit. We don't close half of the remaining position, we close one unit. And here is the magic of the mathematics. You can close whatever unit is opened. You can close the open unit in which order you want. When you will make your final exit, you will always have the same result. So, for example, here, we close one unit. We can close one unit of this trade or of this trade. And when you close one unit here, you can close any unit of any of these trades. The order is irrelevant. You can make a simulation. In this case, close the units in what order you want, and count the number of pips at your final exit. You will have always the same value, the same amount of pips. This is why, for example, the FIFA rules of the NFA, the new FIFA rules, we spoke a lot, is not relevant for us. Why? In a more general risk management approach, when we close one unit here, or when we close one unit here, what we have interest to close first. We have the interest to close first the units which produce the biggest profits. So here, this unit. And when you close the one unit here on our MX2, we have a better interest to close also the remaining units here. Why? When you close a unit, you bank a profit. The profit is in your account. And this profit, you cannot lose this profit. But as long as you have opened units, even if you have stop loss protecting your open position, you can always have, because of an important news, for example, you can always have a contrary movement, a violent reversal, which can touch all your stop loss, with eventually a big slippage, and you can make big losses on this violent reversal. So if you don't close your most profitable units first, you are always under this risk, even if this risk is rare. But you have always to consider it's possible. So, personally, when I close one unit, I always close the unit which is the most profitable, in the order of the most profitable units. In general, if the scalings are done properly, the oldest trade will be the most profitable, then the next oldest one will be the next one most profitable, and so on. You have the exception here where we entered higher than the previous scaling. But this is more an exception than other.
Okay, thank you.
So do you understand this concept?
I think you covered that one quite well. The other questions were, why did you, and it's a reiteration of what you were speaking about when this question was written, but why did you take partial profits at certain points and a full closing of all orders at another point?
Yes. I have said at the beginning that when you see that a trend begins, you don't know how much time this trend will last. We never know in advance. But if you study charts and charts and charts, as max traders, grounded max traders have done during their studies, you will know that statistically, when you opened a MO, you have 3 times on 10, you will not have a scaling. But 7 out of 10, you will have at least one scaling. 5 times on 10, this means 1 times on 2, in 50% of the case, you will have 2 scalings. And in 30 to 40% of the time, you will have 3 scale-ins. So, if you know these statistics, which are clear and which are recurrent from pairs to pairs, from time frame to time frame, you will have the confidence necessary to stay in the trend, and so to keep as many units as possible until the final exit. The final exit will see it with a clear sign, with the indicator. We have already seen an example here with a divergence, but we will see other exit techniques later. But sometimes you will have to close, because here, whenever the store RSI makes a bottom here, you can consider to close a unit. And it is necessary, as soon as you have a first profit, to close one. Here, you make, for example, on this partial exit, you make 70 pips of profits. When we will see the money management approach, you will see that banking these 70 first pips will reduce considerably the risk you will take on the remaining open position. And then we will adjust the stop loss also to reduce the risk. And you will see that from scale-in to scale-in, as long as we will adapt correctly our stop loss at a moment, except with the case where we can have a violent reversal, at a moment you cannot lose. You will have a guaranteed profit because of this banking profit and because of your stop loss. But in doubt, get out. Okay?
Eusebio, can I interrupt you for a moment, please?
Yes?
Eusebio, I've made a list of a couple of questions that have come up here that relate to something that you've already shown and haven't perhaps made entirely clear, or some people would like some clarification.
Okay.
One is when you were drawing ledges. Someone asked, do you draw the ledges on the body of the candle or on the wicks of the candle? Because evidently in some cases there's been some of both or a combination of that.
Yes, that's scholastic question indeed. You have schools which tells to draw the support line here, for example, at the extreme of the wicks, and other school which will tell you no, it is not at the extreme of the wicks but at the open price, for example. The difference is not important. What is important is that you see you have a pullback or you have a ledge here. For example, here we have a ledge here. We have an horizontal consolidation. You have to place visually your support line here or here in a place which seems you logical. Personally, I prefer to draw my support line at the extreme of the wicks. We can have 1 or 2 wicks which go outside the support line. That's not important. As long as the support line you draw is quite parallel to the movement, to the general movement of the pullback or of the ledge, you will have a good place to place your support line or resistance line for an uptrend. Okay,
thank you. Another question that was asked here was when entering a trade, someone asked about the change of color in the MACD, and the question was, does the MACD need to change for a MO or just a scale-in?
No. For a MO, it is not necessary for the MACD to change color. If it is the case, we call that a favorable tumbler. The MACD is only for the scaling. Okay. What will be important for a MO? For example, here, if you draw a vertical line here, there, it will be to see, for example, the store RSI is also in a favorable situation. Here, you see that the store RSI is forming multiple tops here and is pointing down. Here, on the REMO, you have a REMO, which is a scaling in this case, but let's consider it would be a REMO if we had closed all our open trade previously. We would have had a REMO here. You see that the store RSI is pointing down. Here on this could also be a REMO. The store RSI is pointing down. This is very important for the MO or the REMO to have the stir RSI in the good direction. What you will often see for the mode, for the first mode, and I will explain it more in details later, very often for a downtrend, for the mode here, the stir RSI will be quite always in the oversold zone here. And when the stir RSI stay a long time in the oversold zone without forming its bottom, we have a very strong trend, downtrend. And on the contrary, for an uptrend, if the stir RSI stay a long time in this overbought zone, we have a powerful uptrend, and we can stay confidently in the movement. So, okay.
Thank you. Another question that was asked, and you just touched on this briefly, maybe you could clarify this. One of the students asked about the difference between a remo and a scale-in.
Yes, okay. A scale-in happens whenever the MACD change colors, okay? A remo is whenever the price crosses back the Mo line. Here, we have had a pullback above the Mo line, and the price crosses down again the Mo line. This is a remo. This situation also, this is a remo. But as we have not made an XXX previously, we don't call this a remo. We call this also a scale-in. We will have called this a remo if we had previously somewhere here or here closed all our open units. If we had made an XXX. For example, here we have made an XXX. Later, perhaps, here, for example, here, we have, it's not a very good example, let's see, we have the Mo line crossing the blue line here. Here, but 3 bars in the past to the left, 1, 2, 3 here. This is not exactly a remo because the price doesn't cross down the Mo line. So this is not a good example. Let's take another example. Here, for example, let's suppose that here at this moment we have no open trade because we have closed previously all our units. Here we have a pullback above the Mo line and a bar which crosses down the Mo line and close below the Mo line. We have a setup for a Mo, and so you have a Mo here. Okay? Here, let's suppose that here on this movement we have somewhere make an XXX because we have, for example, a divergence here, a bullish divergence. The price makes a pullback above the Mo line, and then on this bar, the price crosses down and closes below the momentum line. So here we have, again, a Mo, and it will be a remo. So the remo is a Mo after we have previously closed all our open units. Okay?
Yes.
Is it clear enough?
I think so. I believe that's been answered nicely. And, of course, the other thing that many of the students have been posting about is stop losses. I know everyone is anxious to learn about that, but I believe you have that scheduled for the next session.
We will learn the stop loss at the next session because we will need to add another very important indicator before to see where to ideally place our stop loss. So,
thank you.
Okay. I think we can stop here for the example on the 5-minute time frame. I will just show you some example of entry and scaling in other pairs and in other time frame to show you that the max method is applicable to any pairs and any time frame. And let's take, for example, let's say the cable, the pound USD, and let's take, for example, the 1 hour time frame. Okay. So here we have, let's take this example here, or this one. We have the price coming from below the home base and goes above the home base. We have the momentum line going above the home base here. At the same time, the blue line is above the red line. We have angle, a nice angle, since the three moving averages are well pointing upward, and we have an excellent separation. And when the Mo line crosses up the home base line, here it is on which bar? What is the setter bar? It is 3 bar to the left. 1, 2, 3. 1, 2, 3. It is at the close of this bar. Okay? The close of this bar. As we are too far from the home base and the Mo line, it's not a good place to enter as a Mo. We have to wait for a pullback to have a safe and perfect Mo. And we have the pullback some bars later, some hours later here, where the pullback is quite right on the Mo line. And so, here, for example, or there, on this bar, you can make your Mo, momentum entry. And then, whenever the MACD turns from red to blue, since we are in an uptrend, here, we can make, not here. You see here the MACD is turning blue, so this is a favorable tumbler for our Mo, even if it comes a little later. But our next scale-in will be, so here. We draw it this way. We call it SC1. The second scale-in will be here. Is it a good one? No, we are under the Mo line. So this is not a good scale-in. We ignore it. Let's take the next one here. Is it a good one? For me, it's not a good one. We are still under the Mo line. Let's take the next one. Here we have a good one. We are above the Mo line. And with a nice pullback, and we can draw the resistance lines of this pullback, and we have our entry around this level, and we call this our second scale-in, SC2. Okay? And then we have another scale-in here. Here, there, with another nice pullback. We call it SC3. If we take it, we will have to check if this price level is not too close this level. Let's see how many pips we have. We have 32 pips. That's acceptable. And the next one will be here. Yes, there, after another nice pullback or ledge, if you take or not into account this longer wicks in this consolidation zone. And so we have here our fourth scale-in. Now let's see for the exit. So here we have tops in the RSI, so we may consider to make a first profit here. Let's see where it is located. It is located this way. Okay, how many pips do we have from our Mo line to this bar, which is indicated by the RSI? We have approximately 60 pips. We can consider to take a profit at this level. On higher time frame, for example, H1, when we have 50, 100 pips of profits, you can consider to take a partial profit. So, for example, we will see other signs which will indicate it would be a good place to take a profit later. Okay. Here we have another tops in the RSI. Here. So it's nice to take a profit, a partial profits here. And here I will give you a second technique to exit. Whenever you see the price making a steep angle here with long bars, you see this bar, it is a long bar. This is a long bar compared to the previous bar. And if the RSI makes tops, if you have the conjunction of the two, but it's not always necessary to have an extreme in the story RSI. Simply the fact that you have a long bars, you must always consider to take a profit. We call that an opportunity exit. A long bar is always a blessing to take profits. So do not hesitate when you see on the next bar that the bar begin to retrace and begin to be red. Don't hesitate to take a profit and to make so an MX2 here. I have forgotten to note the MX1 here. And then here we see later that we have a nice bearish divergence this time. We have two lower highs in the store RSI, but we have two higher highs in the price. So we have a nice bullish divergence. We are far from the beginning of the trends. So we have also a long bar here compared to the previous one. So we have an excellent point here to make an XXX. Okay? And now we can count how many profits we have taken from this max trade. Vanessa, are you ready? So we entered here and we closed the first unit there, making 69 pips minus the spread, which is 3 pips here. So let's say 65 pips. And on the second units, let's say 185 pips. On the first scale-in, here we take a profit, for example, here of 115 pips. And on the second units, 150 pips. Remember that we can close the units in whatever order you want to count the pips. On the next scale-in here, we make 85 pips twice. On the third scale-in, we make 60 pips twice, and on the last scale-in we make here 50 pips twice. How many pips? Isn't it nice? Now, if we had placed a tight stop loss somewhere here, for example, but we will see the stop loss next time. But let's suppose we would have placed a stop loss here, and we would have waited for the stop loss to be hit. Here we have an example of a losing trade. Why? Because on these two units we make a loss. On the second unit here of this MO we are break even, and the first profit we have made on this unit here is perhaps not enough to compensate for the loss we have made on the two units of the first scaling. But as we will see more in details next time, the stop loss we will fix will be always an emergency stop loss or a catastrophe stop loss. It will have to be far enough from the price to leave enough place for the price to breathe. But if we see at some times that the movement, the uptrend is invalidated, and we will see that later also, we do not have to wait for the stop loss to be hit. We close the trade before the stop loss is hit, and we reduce the loss we can make. Okay, but we will see that in detail in one of the next sessions. So, okay, so you have seen that.
Can I interrupt again here for just a moment? There's been some question about that fourth scale-in number 4 that you show. And I think because some of the folks are not taking into consideration the fact that this is a 1-hour chart, the question came up that the MACD at the bottom in the lower window would not be blue until that candle closed. But I know you have a different explanation about when to enter that SC4 as that candle progresses.
Yes, indeed. It depends. We can only say that real time. You see that the MACD, let's make a zoom in. we'll see better. We see that here, the MACD, we have a rather long bar, blue bar on the histogram. So the MACD turns blue somewhere here, not at the end of the bar, but somewhere before the close of the bar. So I have explained to you that we have several techniques to enter scaling. The techniques I explained previously, it is when the bar closes. In this case, indeed, we do not have an entry level for the scaling, but we can also enter sooner. It is a little more risky, of course, but we can enter sooner. As soon as the MACD turns blue, before the bar close, and as the price is above the resistance line of the retracement here, of the pullback or the ledge, we can enter. And so perhaps we would have entered here, or here, or perhaps here. In this case, for example, we know we will have a long bar. We do not enter. It depends real time what happens. Okay? On the fixed chart, it is difficult to say where is exactly the entry price. But when we will practice real time, you will see this very easily. Okay? Other questions? So have you seen you can apply the max method to any pairs, to any time frame. You can also use a H4 time frame, for example. You would have here a very nice WIMO in particular. You can, with some practice, you will spot them immediately. You can use a 15 minutes time frame, a 30-minute time frames, and it will be your responsibility to practice along the different sessions all the time frames to see, to experiment with which time frame you will feel the most comfortable. And when you will trade live, you will trade the time frame you will feel comfortable with. It is very important that your trading style is completely current with your temperament, your personality, and it is mainly linked to the time frame. 5 minutes is perhaps too dynamic, too reactive for some traders, and H1 will be perhaps more adequate. And the contrary is also true for other traders. I know traders which have much fun trading the 1 minute time frame, for example, but other having a total comfort with the daily time frame. So it's up to you to find what is the more appropriate time frame for you. Okay? So now the homeworks. It will be asked to each new student to take on a 5-minute time frames. You can choose whatever pair you want, and you will make 2 max trade. 1 long max trade with the Mo and the different scaling, partial exit, and the final exit. And a short max trade, a short trend with a short Mo, short scalings, some 1, 2, 3 partial exit, and a final exit. Okay? Don't do these homeworks at the end of the chart. Instead, go backward. Go at the beginning of your chart, pushing your home key on your keyboard, and make scrolling the chart and point to such movement on the same pair or on 2 different pairs. And you will note the Mo, the scalings, the MX, and the exit as I have shown you previously. So with a slight slanted white bar for the Mo and for the scalings, a vertical line for the scalings, and a horizontal short line for your MX and for your exit. And you will count the pips you have made on this max trade, the total pips you have made on this max trade. You will have to save your chart. To save the chart, it is easy with MetaTrader. You can do that way. You right-click with your mouse. You choose Save as Pictures. You click Active Charts as is. You click OK. You give a name to the chart, and the name you will have to choose will be your name, so that the graders can recognize to whom is the homeworks, the pairs, pound USD, the time frame, and you will indicate, for example, if it is a long trades or a short trades. Okay? And eventually you can add the date of your homework, for example, 2009, August the 5th, if you do then today or tomorrow for some of you. And you click Save. Okay? And you post your two charts on the Google group for the new student and on the forum for the returning graduate student. Okay? Question on that? Do the homeworks are clear? No question, so everything is clear. I will ask you, in order to have, for the graders to have sufficiently time to grade all the homeworks, and for you to see the homeworks of the other, I will ask you to send your homeworks before Friday noon East time. Okay? And please don't wait the last moment. Don't rush at the last moment, seeing that you are more than 60 or 70 students. This will represent 150 charts to grade. So don't rush at the late moment. As soon as the video will be ready, Chris will send you the video, review the video for the definition of the mode, of the scalings, of the partial exit and the total exit. So review the video 1 time, 2 times if it is necessary, and then do as soon as possible your homework and post your homework in the Google group. Okay? If you have questions about how to do that, Chris will give you some help about the manipulation to do. Okay, now if you have some questions, we can take some minutes to answer them before to close this first session. Sanctuary.
Hi, while you're typing up some questions, if you're going to, I'll just let you know that I'll be sending through 4 emails to the Google group. They are on how to send your homework in, how to take a picture on the chart, just like you, Savio, showed, how to attach it to an email, because you cannot go straight into the Google group with a chart. You have to email it into the Google group. And there's a 4th one there on how to attach the templates and the indicators that we'll be sending out shortly to your MetaTrader platform. They're quite easy, and there are also PDFs in the Google group that are available for you to download. So if you go back to a browser with the Google group address, in there's an area called Files, and within that is 3 PDFs that can help you with all that information as well.
Okay. So there are some questions from students. For example, please define where we enter again. So it would be at the open of the next bar, but sometimes you enter in the middle of the candle, judging from the line you draw on the chart. Or am I wrong about this? I have explained to you that there are several techniques depending of your how risk averse you are. When you have a setup bar, for example, let's suppose here we have a setup bar for a REMO or for a MO. This is the setup bar. So the more risky way to enter is on the next bar, on the open of the next bar, here, okay? Here. The more conservative way to enter is when on the entry bar, the price goes above, for an uptrend, above the close of the setup bar, so here. And still the most conservative way to enter is when the price on the entry bar goes above the high of the setup bar, so here. And we can take a few pips above, okay? And it's up to you to choose the way you feel most comfortable. Another question: do you use also hidden divergence, MB? No. You can consider hidden divergence, but it is not necessary with the max method because hidden divergence is just a continuation pattern for the trend, and the continuation of the trend you will see it with the angle and separation of the moving averages. In an uptrend, I see that it is also possible to enter when the store RSI crosses from below instead of using the MACD for scale-ins. No, the scale-ins is done with the MACD. The store RSI is used for the exit. Each indicator has its own role. Okay? You must not mix the roles of each indicator. And there is a reason. We will explain it in a later session.
Just one more thing is that you can pick the perfect chart to send in. You're only learning this, so you don't have to pick nasty charts, nasty trends or anything like that. You can use perfect examples to show us. We just want to make sure that you know how to do the scale-ins, how to do the partial exits, and how to do the full exits, as well as the Mo entry.
Yes, do not complicate your task for the moment. Learn to recognize the right situation on easy cases, and then you will be able to complexify your homework later. But one thing at a time. So choose nice entry. Even if you know, for example, for your final exit, what the price has done. But doing that, you will train your eyes and your brain to recognize ideal situations. And I assure you that these kind of practice will help you when you will have to trade live. And one advice, do not trade live now. Even demo. Don't trade demo real time now. Study past chart. Okay? Okay. Well, so the next session will be Saturday. So it is Saturday at 5 p.m. East time. In the Google group, when you will post your chart, please do not post unnecessary emails. Do not send unnecessary email. It is not necessary to thank you. It is not necessary to express you are grateful. You will see that you will receive the email of each one in the group. This will be hundreds and hundreds of emails during all the 7 sessions. So we have to make an effort to limit the number of emails. So just necessary emails for the homeworks, for the grading, and for the questions. If you have questions, you have of course the right to pose the questions, to ask the question. Sorry.
Okay. So thank you, Eusebio.
So Dave, you can pose the question in an email for the Google group. So okay. You're welcome, and good work to all of you. And see you next Saturday. Bye bye.